Hi everyone, welcome to today's webinar. My name is Jason Q. I'm a managing attorney for the nonprofit and small business legal assistance programs at the DC Bar Pro Bono Center. Our topic today is going to be part of our board basics series, and we're going to be talking about setting executive compensation. Really excited to talk about this topic. A few, housekeeping notes before we start. For those watching the presentation live today, you can get a copy of the slides by going to your GoToWebinar panel, finding the handouts drop-down menu, clicking the little arrow, and downloading the PDF version of the slides there. So for folks who want to take a copy of the slides with them or follow along locally, that's your option. Also, again, for folks watching this live, there is a questions panel on the GoToWebinar interface. Again, there's a drop-down menu. You click the little white arrow. That's going to allow you to ask questions throughout the presentation. As I move through the presentation, I'll pause every couple slides, check on the questions, and answer them if the timing is right. I might not get your question right away. I might wait until later in the presentation or the end of the presentation, depending on where your question fits in with the flow of what we're going to be talking about today. But I will try to get to everyone's questions. If I don't get to your question over the course of the presentation, please feel free to email me or to reach out to us at the Pro Bono Center. My email address is jqu@dcbar.org. I'll remind people of that at the end of the presentation as well. All right. I think that's it for logistics. Let's go. Before we start, just a really quick intro about my organization, the DC Bar Pro Bono Center. We are a legal services organization here in the District of Columbia, and we have a nonprofit legal assistance program. Part of that program is hosting virtual and in-person legal clinics to address specific issues related to nonprofit law, governance, and operations. We sponsor trainings, webinars, and podcasts on real-world issues facing nonprofits, including our event today. We provide a library of written resources and archive training sessions on our website, and we match pro bono organizations with pro bono counsel. Pro bono matches can help with many different types of legal matters, including corporate governance, IRS compliance, employment law, real estate matters, the whole gamut. So between our resources, our brief advice services, and our match program, we are here to help and to serve nonprofits in the DC region with your legal needs. So please remember that and keep us in mind as a resource. One resource that I want to highlight is our Board Basics webinar series. Today's event is part of a series of really great, short, all under 1 hour webinars that really get into the nuts and bolts of what the legal requirements are when it comes to running your board of directors. So you'll see we have webinars on whistleblower policies, on committees, conflict of interest, huge topic that will be relevant to what we're talking about today, and calling your board meetings, taking minutes, meeting executive session, the whole gamut. So I really encourage people to go to our website and to check out the section on serving on the board of directors, where we have these webinars plus a host of other guides and resources for folks, especially folks who are new to serving on nonprofit boards. All right, so let's then get to the meat of today's conversation, where we're going to be talking about executive compensation. And so I want to set the stage first, talk about why executive compensation is an important topic to talk about. First, there's sort of the business case, and this is really important. It's that the CEO is critical to the success of your organization's mission, and the compensation of that individual affects your ability to recruit and retain qualified individuals. On the other hand, you're also working within your organization's financial resources. So, the big, I'm going to focus a lot on the law today, but I want to highlight that a countervailing consideration for a lot of people is using compensation to attract and retain talent. That's not really what we're going to be focusing on as much today. The IRS rules around executive compensation, as you'll learn, are really focused on excessive compensation. From a legal perspective, the worry is paying your executives too much. When we're talking about this business angle, it can often be about not paying your executives enough. It could be about paying your executives too little. So you're going to walk away from today's presentation with a little bit of an unbalanced view. of the conversation that we're having. I'm going to be focusing a lot on executive compensation. That's a, you know, a lot of our organizations, it's a lucky thing if you have the money to worry about paying your executives too much. But nevertheless, it's really important that your boards understand how to deal with that compliance piece of it. So that's what we're going to be talking about today. As a legal compliance matter, determining executive pay is part of each director's fiduciary obligation to the organization. That's a unique duty of directors. And the IRS itself has a keen interest in executive pay decisions in the nonprofit world, especially in preventing excessive compensation. I don't have it on the slide here, but there are other government actors like the Attorney General who might, in really, really egregious cases of excessive compensation, also be stakeholders and possibly enforcement agencies in this area. You know, there's a big story that came out last year out of South Florida in the case of a domestic violence nonprofit, for example, where allegations of excessive compensation, really dominated the news cycle for a bit, and brought a lot of attention and light to this issue of compensating executives at nonprofits. So we're not going to focus too much on, you know, getting investigated by the AG. That's a really rare occurrence. Let's talk about those fiduciary duties really briefly. You know, most of my presentation is going to be focused on IRS rules, but I want to note that individual directors also have a legally recognized and enforceable duty under their duty of care to ensure that nonprofit resources are safeguarded and not misspent. Paying excessive compensation is a form of financial mismanagement that directors have a duty to prevent. So not only is there this kind of deep and interesting and really relevant body of IRS rules affecting how much and how you compensate your executives, but there's also at the level of individual directors a legal duty to make sure that the compensation that you're paying at your organization is reasonable. Okay, so I've teased it enough. Let's get to the IRS rules around nonprofit executive pay. Again, the IRS rules focus on excessive compensation, really in the context of nonprofit organizations. Executive compensation is a big IRS audit and enforcement target. And this goes back to all the way when you applied for 501c3 status. So for folks who did the full form 1023 application, this will be a blast from the past, but there was a whole section on the application for nonprofit status that asked about how you were going to handle executive compensation. I really like the full form 1023. I think it's a great learning tool even after you've gotten 501c3 status to go back to the form, because in the form the IRS is really hinting, you know, giving you as strong an indication as possible about what it thinks a nonprofit should be doing in the world of compliance. And this executive compensation piece is, you know, no different. It's asking you a bunch of leading questions about how you're planning on compensating your executives, and in so doing is giving you a picture of what the IRS thinks a robust and legally compliant nonprofit compensation package looks like. So, you know, it's asking, will your organization approve compensation arrangements that follows your conflict of interest policy? Are those arrangements going to be approved in advance? Will you document the approved compensation arrangements in writing and then record the decision made by each individual who voted on the compensation? Will you approve compensation based on information about compensation paid by similarly situated nonprofit organizations? I'm going to focus a lot on that requirement. Do you or will you record in writing the information that you relied on? And do you have other practices that you use to set reasonable compensation? So right here, from, you know, the birth of your organization, the IRS wanted you to start thinking about what you were going to do to make sure that your executive pay was fair and reasonable and not excessive. So this is sort of a roadmap for the topics that we're going to talk about today. Also, I do want to note that for the folks who file the full Form 990, there are also questions on that form annually about your executive compensation process. So in this section, did the process for determining compensation include a review and approval by independent persons, comparability data, and contemporaneous substantiation of the deliberation and decision? Right there, the IRS again just like in the 1023 on the Form 990, giving you a very strong hint about what it wants you to be doing to be legally compliant in this area of executive compensation. All right, so we're going to talk about this. Let me just provide some legal background and define some terms that we'll be using for the next little while. 501c3 organizations, as tax-exempt organizations, they must be organized and operated so that no part of its net earnings inures to the benefit of any private shareholder or individual. We call this the private inurement rule. Nonprofits are, supposed to be operated for a public purpose, to pursue their charitable mission, and unlike for-profit corporations that can pay dividends to shareholders, etc., no part of the earnings of a nonprofit can inure to the benefit of a private person or individual, or business for that matter. Now, everyone's asking, wait, but don't we pay salaries? So yes, but the payment of fair and reasonable salaries, that's a business expense. That's part of what we need to do to keep the organization running, to pursue that mission and to produce all these public goods. So that's okay to pay people salaries, to pay people compensation, but the compensation has to be fair and reasonable. And the crux of this executive compensation discussion is figuring out what is reasonable compensation for folks such as the executive director and other folks on our team. Okay, so let me take a peek at our questions really quick. Okay, these are good questions. I'm gonna get to these questions, so I'm not gonna hit them right now. Alrighty, okay. Another concept that I want to define is excess benefit transaction. Specifically in this area, IRS rules exist to prevent excess benefit transactions. An excess benefit transaction occurs when the value of pay or benefits received by a so-called disqualified person exceeds the value of the services that they performed in return. So we're looking at any base salary, grant, loans, compensation, or similar payments received by the disqualified person. And if it's too much, we might use the terms excessive or unreasonable compensation in our conversation today. Who are these disqualified persons? Think of them as the insiders or the core sort of leadership team of the organization. They include any person who is in a position to exercise substantial influence over the affairs of the organization. And that includes the CEO, but it also includes other members of senior management. It also includes the family members of those people, and there's a 5-year look back rule. So today's presentation is mostly going to focus on compensating your CEO or executive director, because most nonprofit organizations have someone in that position. Not all of you have other C-suite officials like a chief operating officer, a chief financial officer, but if you do, this conversation applies to them as well. It also applies to people who are formerly board members, people who are or are formerly officers. Anyone who is or used to be in a leadership position in your nonprofit can be a disqualified person, and the IRS has specific rules about overpaying or overcompensating these nonprofit insiders. The idea here is that because they're insiders, they can control and influence the organization. So it's particularly risky, and we need extra oversight when it comes to how much nonprofits pay these people. All right. So what happens if we commit an excess benefit transaction? What happens if we overpay our insiders or our leaders? At the very worst, the nuclear option is that the IRS can revoke your nonprofit's 501c3 status, but the IRS also has the option of levying what it calls intermediate sanctions. These are excise taxes or extra taxes under the tax code. What are these intermediate sanctions? So if you do pay excessive compensation to your nonprofit insiders, the IRS can impose an excise tax worth 25% of the excessive compensation on the person who received the compensation. So if I overpay my executive director $100,000, the IRS can levy a 25% tax on that $100,000. Just claim it for itself. Also, on the directors who approved the compensation, they are also potentially financially liable in their individual capacity, liable to the value of $20,000 or 10% the value of the excess benefit, whichever is less. So this is one of the really few rare cases in the nonprofit legal world where you as a director of the nonprofit could be personally liable for a decision that you make and pay financial penalties for a decision that you make in this context of excess benefit transactions. Theoretically, if we overpaid our executive director $10,000 and you approved that overpayment, you might have to pay the IRS 10% of that amount. The executive who receives the overpayment must also return that money to the organization, or they have to pay a penalty of 200% the value of that money. Okay, so there is some financial skin in the game when it comes to these excess benefit transactions. Okay. A few folks just joined us on the webinar, so I want to do a quick reminder that if you're watching this live, you can get a copy of today's slides by dropping down the handouts tab on your GoToWebinar platform and clicking on the document there. Okay, so I've kind of spooked you a little bit. I've told you what could possibly go wrong. Now let's talk about what we can do to protect ourselves and to try to comply with the IRS rules around reasonable compensation. By effectively managing the compensation process, an organization can shift the burden to the IRS for establishing excessive compensation. We have something called a safe harbor process. In other words, if we follow this IRS-approved procedure, the organization creates what we call a rebuttable presumption that the executive pay it's chosen is reasonable compensation. And in practice, the IRS very rarely, perhaps very, very rarely, will enforce against an organization that's gone through this safe harbor process. Another benefit of following the safe harbor process is that directors are insulated from personal liability if they follow the procedures and if they rely on outside experts as part of that deliberation process. So that's going to be what we're going to be focusing on from now on. It says IRS safe harbor process. What does the process look like? There are 4 elements that we're going to talk about. First, your executive compensation has to be approved in advance by a designated body. Second, kind of intimately related to that first point, is that there can be no conflicts of interest on the designated body that approves the compensation. The designated body has to rely on adequate comparability data or sort of market benchmarking with respect to the amount of compensation that you decide to pay. And finally, the whole process has to be documented contemporaneously and adequately, and then that will help you to prove that you followed the process in the first place. Okay, alrighty. Okay, so let's go through those 4 steps one by one. So that first step again is prior approval by a designated body. The compensation that you pay your executives must be approved in advance by an authorized body. The authorized or designated body is typically either the whole board or a board committee. This is a really important note, especially and a good reminder of something in nonprofit law for DC folks. If it is a board committee, the committee can only be made up of board members. You can have non-board members advising the committee. You can have them coming in doing presentations, consulting, but they can't be voting members appointed to the committee. This is because voting on and approving executive compensation is a core board function that is, that is meant for directors only. So we can't have non-directors taking on the responsibility of voting and approving something, which is ultimately the director's responsibility to do. Okay, so if you do it on a board committee, make sure that the voting members, the formal members, are only directors on the board. Let's talk a little bit more about that committee option. Do we do a full board or do we use a committee? And if you do use a committee, which one? Some organizations use their executive committee, which is sort of a subset of the full board that can meet more often, is a little bit more flexible, is a little bit more nimble. Some organizations have a specialized compensation committee. Others might have an HR committee that takes on this role. Sometimes it might make sense to spin out a task force, so not a full standing committee, but just a temporary one-time or occasional task force of a subset of the board. you have a lot of flexibility here. There are no rules about which form to use. The considerations really are, one I would point out is board size. So if you have a really large board, it might not make sense to engage the entire body on setting compensation, or at least doing the initial legwork, because it's such a specialized and occasional task. So for folks with larger boards, it might make more sense to rely on a committee to do the initial legwork and then just have the full board approve the proposed compensation arrangement at the end of the day. Committees are also useful because they can leverage compensation related expertise more efficiently. So if you do have folks on your board with some HR experience or with experience in this area, it might make sense to spin them off into a committee with some other officers and some other folks from the organization, just to kind of highlight and then give them an opportunity to really leverage those skills without having to take up the attention of the full board all the time. So those are some considerations. And I guess another consideration is what your existing committee structure looks like. Again, for folks with an executive committee or an HR committee, it might be pretty efficient and pretty easy to spin off the executive compensation responsibilities onto those existing committees. But again, if you do want to spin off a new committee to handle this issue specifically, you could do it through a task force or perhaps through a compensation committee. Okay. All right. So that's the talking about whose responsibility is it to set that compensation. Is it going to be the full board? Is it the committee? No matter which option you choose, critically there could be no conflicts of interest on that body between the people voting on the compensation and the people receiving the compensation. So no person voting on the compensation of a disqualified person, again, these are your insiders, your leaders, may be the direct or indirect recipient of that compensation, so they can't themselves be the ones voting on their own compensation. That should be pretty obvious. They also can't be a family member of such person. So if my spouse is the executive director, I cannot be part of the body that votes on their compensation, okay? They can't be in a position to benefit financially if the compensation is approved or disapproved. They can't work under the disqualified person. So if I am on the board of the nonprofit, but I'm also an employee of the organization and the executive director is my boss, I cannot be voting on their compensation. The idea there is that I might be incentivized to overcompensate them or to give them a kind of sweetheart deal. And that doesn't, that's a conflict of interest on my part. The people voting on the compensation can't be an employee whose compensation is subject to approval by the disqualified person. So that's a more specific example of what we just talked about. They shouldn't share a business interest with the disqualified person and or be involved in any financial transaction with the organization that is subject to the disqualified person's approval. So if I am on the board and I'm on this compensation committee, but on the side, I also own a printing business, and my printing business is a contractor with the nonprofit. I provide, maybe really cheap, great printing services to the nonprofit. I still should not be on the body that votes on the CEO's compensation, because the CEO is the one deciding whether or not to retain my services for the organization. And so there's a conflict of interest there. Again, I might be incentivized to overcompensate the CEO as a sort of backdoor way of making sure that they continue to use my business going forward. So these are a lot of really specific fact patterns. The IRS does this a lot. You see this a lot in nonprofit law. We're brainstorming all the different ways that conflicts of interest can arise. If you're feeling a little overwhelmed, just step back and look at the underlying principle here, right? We don't want anyone voting on a person's compensation if they have any sort of non-objective skin in the game of how that compensation decision works out. They're the recipient of the compensation, they're related to the person, they have business interests with the person, or they have other sort of personal or business interests that might incentivize them to especially choose a higher compensation than what the person really deserves or what is appropriate in the situation. Okay, so we have this designated body, or we have the full board voting on compensation. We've eliminated people who have conflicts of interest from that body, from going through the process. What is the process itself? The crux of the process is that the board needs to rely on adequate comparability data to establish what the compensation market is amongst their peer organizations, right? So we're going to find peer organizations that have a similar mission, size, budget, and are in the same geographic region as our organization. In some cases, it might make sense to also look at pay to for-profit businesses where there is a clear analog in positions. So an example might be, if you're like a medical nonprofit or a nonprofit hospital, and you're paying doctors to be your chief executives, or for me in the legal field, we're paying lawyers to be our chief executives. Then there's a clear analog between our world and the for-profit world. We might look at the for-profit world itself as well when we're setting this comparability range. But anyways, so we're going to find peer organizations, and we're going to see what the range is amongst those peer organizations in our region with respect to the compensation of the chief executive or whatever position we're looking at. How do we do that? Again, you have a lot of options. One way to do it is to look at the 990s of those peer organizations. You report your executive compensation on your 990s, except for the 990 postcard for really, really small organizations. But anyways, the 990s contain a wealth of compensation related information, so we can look at that. You might be able to scrape some salary information from job offers, job listings, or even inquiring directly with organizations about how much they pay, as long as you document that research. There is a whole world of compensation surveys and studies available. So there are organizations and companies out there whose job is to sort of survey the field of nonprofit executive compensation, and they will very conveniently give you a compensation range. You're going to have to pay for it almost all the time, so that's a bit of a more expensive option. And even more perhaps expensive option is to rely on some outside experts. So you can use folks, accounting firms with experience in this area, legal counsel with experience in this area. And again, there is also a universe of third-party compensation consultants who specialize in helping nonprofits determine this compensation range and understand what reasonable compensation looks like for their organization in their particular market. So you have a lot of options for how to do this. Let me give you an example of one of these compensation reports. This is not an endorsement. I really just want to, provide an illustrative example of what this kind of report can look like. So I pulled this off the GuideStar, also known as Candid, from a few years ago. So this is what the GuideStar report looks like. It's going to give you, I've organized it by budget size. That's what I'm focusing on. You'll see that for organizations with $250,000 or less, on average across the nation, they pay their CEOs $46,000, right? We're talking about really small organizations. Then here we have a 10th percentile and a 90th percentile, 20,000 and then 76 on the high end. So that gives you kind of a snapshot of what that looks like nationwide. Now, when you're actually doing this analysis, you're going to probably want to do it regionally. And so in our DC region, that figure is probably going to be a lot higher, which is good because it gives you more of a window to play around with. That 90th percentile is going to tick up a little bit, for example. And you'll see then down, then it goes up the budget ranges. So this GuideStar report breaks it down by budget size, it breaks it down by geography, it breaks it down by organization type. So, for a social services or human services organization versus, international development versus other kinds of nonprofit, it'll break it, education, healthcare, it'll break it down by those areas as well. So you'll get a lot of different ways of slicing the data and determining which compensation range fits the best for what your organization actually does. For organizations with under $1 million gross receipts of under $1 million, the IRS has a special mini safe harbor for you, where they've specified that you can just rely on 3 comparable organizations in the same or similar communities that provide similar services when you're doing this compensation analysis. So for those folks who are under $1 million, just find 3 peer organizations using 990s or using other documented salary information, and just with those 3, you can create your range. 1, 2, 3, a low, a high, a middle. That's enough. The IRS is less specific about what larger organizations over $1 million have to do. For you folks, it's probably better to do a more robust study. Again, looking at the last one in the slide, pulling a much wider number of 990s, or using those compensation surveys or studies or outside experts. Again, reliance on the outside experts is useful because not only does it provide you with good, robust information, it also means that your board of directors isn't individually doing the legwork, and it can reduce some of the legal liability for them on the back end. All right, this is a good time for me to then go through. We've done a good amount of the presentation now. Let me go through the questions again and see if there are any that we should talk about at this point in the presentation. So someone asked, can compensation decisions be delegated to the board? That's a yes. Let's see here. Does D&O insurance cover approval of excessive compensation? Usually no, usually that'll be written out of your policy, but you'll have to look at the specific language in your policy. Can information about government pay scales in fields related to the work also inform ED compensation as well as for-profit labor market info? Yeah, certainly, especially here in our DMV region, where there is a lot of government employment. That could be a useful source of pay information, especially if your field can or sort of customarily includes folks who come in and out of the government. There are also nonprofit organizations that are, government agencies or that are government sponsored. So there are some ways of pulling that information from the government as well. Definitely can be relevant if, again, it's a comparable mission, geography, budget size, etc. Let's see here. Do the committee members have to do research on the 990s themselves, or can the ED CEO help? No, I would not have the ED CEO participate in this process in any way. The whole idea is that this process is totally independent of the person receiving the compensation. And that independence is going to be key in providing protection from legal liability. Let's see here. Can the board request that an organization's in-house counsel gather published comparability data for this benchmarking process? Is it problematic that counsel's own compensation is set by the example of conflict? So there's one example where if you have in-house counsel, so you have your own lawyer whose own compensation is subject to the approval of that executive director, that is a conflict of interest. That person should not be on the committee, and that person should not be voting on the ED's compensation. They can do some of that initial legwork and pass it along to the board or the committee that's doing the work. But the board or the committee, ultimately, they hold the bag. They have the legal liability. So if they're relying on outside experts, that provides a high level of assurance. But if you know it's your own in-house counsel, and there's a potential, even theoretical risk that they might not be doing a full or accurate job of that analysis, the board should be sort of double checking that work or consulting additional sources just to make sure that the data is clean and is good. Someone's asking about bonuses. We're going to talk about them soon. And then someone's asking, for the mini safe harbor, for this $1 million safe harbor, would government grants be included as gross receipts? Yes, gross receipts includes basically all of the money coming into the organization. Okay, a little side note, I want to mention that the IRS does ask about how you do this comparator analysis for the folks who file Schedule J on their Form 990. That's not everyone. First of all, not everyone files the full Form 990. And then only some organizations, for example, organizations that pay someone over $150,000 have to fill out Schedule J. But again, as I've said a few times now, these IRS forms are so useful for getting into the mind of the IRS's agents and figuring out what their priorities are. So here on the form, the IRS lists, what it thinks are useful methods for organizations to establish comparable salaries. Do you have a compensation committee? Did you use independent compensation consultants? Did you pull data from Form 990s? Do you have a written employment contract? That's important because that proves or is evidence that you set the compensation in advance, that you weren't just sort of making it up as you went along. Did you use compensation surveys or studies? And finally, did you get approval by the board or a compensation committee? That last one should be a gimme. Everyone should be checking that one off. Either the board or a compensation committee should be approving these arrangements in advance. That goes hand in hand with that idea of having a written employment contract. Okay, a few more pointers about this comparator analysis. So first of all, compensation doesn't just mean base salary. Include your non-qualified pension contribution, retirement contributions, bonuses, and taxable perks. All gets included in the bucket of compensation. With respect to those bonuses, or what we might call non-fixed compensation, if you do pay bonuses, you still can preserve the rebuttable presumption and use the safe harbor process. If you fix a cap on the amount of the bonus, a maximum amount under whatever algorithm or process that you use to determine the bonus, and then include base salary plus that maximum bonus in your compensation figure, and then use that figure for benchmarking. So if your base compensation is $100,000, but the executive director is eligible for like a $50,000 bonus if they hit all these benchmarks, your compensation number for purposes of benchmarking is $150,000. It's all of it together. Even if they might not necessarily get the bonus, again, for the purposes of benchmarking, to be conservative and to be safe, we're going to use the entire amount. Another note here is that deciding to compensate someone, above market is not necessarily an excess benefit transaction, but it does significantly increase the risk of it being found to be an excess benefit transaction. So if you're compensating someone at that 95th percentile, or if for some reason you want to blow past the scale and pay your executive more than any other organization you found during your research, you pulled like 2990s and found all these compensation ranges, and none of them seem to be quite enough for how much you think this executive deserves. It's not illegal to pay them more, but just know that it does increase the risk that the IRS will sort of flag this and look at this. It increases your audit risk, and that you're going to need to defend that decision. Why do you think, even though we have comparability data from all these peer organizations, why do we think we still need to pay our executive more than what other organizations are paying? Is it because they are just uniquely qualified in the field? No other organization has an ED with this much experience and with this much impact, and or maybe you're one of those organizations that's using one of these non-fixed structures where you're paying the ED partially based on how much they fundraise. And one year they got a massive grant, or they came up with a new campaign that brought in oodles of new money into the organization, and you promised to pay them 25% of whatever new money they brought in, and that blows them out of the range. Well, okay, if you had that process, if that was your agreement and they really were that successful, then it might be okay to pay them above market. But just know that the higher up you get on that percentile scale, the more risk it is that this might end up being deemed an excess benefit transaction by the IRS. The safest way to go is of course to keep it at like 50% or lower on the scale, but you certainly don't have to keep it at 50%. You can go over 50 as long as you have that risk tolerance in your organization. And then one other sort of random note: as of the 2017 Tax Cuts and Jobs Act, there's a special excise tax on compensation over $1 million. I don't think that affects very many people on the call today, but just know that if you do pay an executive over $1 million, there's a 21% tax that just gets tacked on to that compensation that you have to pay the IRS. So that's a new rule for newish rule for nonprofits. Go through. Oh, okay, someone's just asking, what do we do when our dollar amount maxes out our market research? And they're asking about CEO tenure. Yeah, CEO tenure is definitely something that you can consider when we're deciding what the appropriate compensation is. And again, if you do want to go above market because you've had a CEO around for so long, they've provided so much service to the organization, they're so senior, that could be a good reason, but you just have to be ready to justify that if the IRS does come knocking, because you've technically sort of exceeded or gone above what this safe harbor process provides. Okay, and then the last point is less interesting and less impactful, but still really important. It's that this whole process needs to be documented adequately. So your executive compensation process and decisions should be properly documented at the time they're made. That documentation should include the date that the compensation was, the date the approval was made, what number you landed on, what specific decision you made, the names and roles of all the decision makers. So again, all the people on your board or all the people on your committee. The identification of what comparability data you used. So again, did you pull the 990s? Did you engage in a compensation consultant? Did you buy one of the compensation surveys, et cetera, et cetera? And information on specific conflicts of interest and how they were resolved. If someone was on the committee or was on the board, but they were deemed to have a conflict of interest and were removed from the decision-making process, document that, because that's a good thing. You know, you want to remove those people. So if you're doing the work of scanning for conflicts and removing people, include that in your documentation regarding this process. If you did the analysis and no one had a conflict of interest, document that as well. Say we did the analysis and we found that no one had a conflict of interest. Everyone was okay to vote on this decision. From a reporting perspective, you'll be reporting your compensation, certainly on your W-2s and on the Form 990 that you file with the IRS as well. This brings us to the topic of compensation policies, because there is sort of a, concrete process here that we should or need to follow. A lot of nonprofits will adopt a compensation policy to provide a roadmap for the process, to provide a context for how these decisions will be made. A good thing about having a policy is, aside from all this legal stuff, aside from all the compliance stuff, you can also emphasize the strategic or philosophical objectives of your compensation program. So you can focus on matters such as, who your compensation setting body is, how you're going to determine peer groups, where you want to be in the market, like what percentile, 10, 20, 50, 90 you want to be at. And if you are going to link pay to performance, if you're going to have that non-fixed compensation structure, how you're going to do that. And some of the performance factors that can influence compensation include success in carrying out your organization's mission, meeting financial objectives or fundraising goals, success in internal management, ability to plan strategically and ensure future viability. So a lot of orgs will take these considerations into account, either as part of their bonus setting process, or in deciding where in the compensation range to set their particular executive. You might look at some of these factors and say, okay, we think this executive should be in the 75th percentile of the range that we found versus the 25th percentile or something like that. That could be part of the strategic decision that the board makes. Okay, so here's a question from the audience. With regards to conflict of interest, if the founder is also the executive director and is a voting board member, if we remove them from voting, would we comply with conflict of interest requirements? It depends on whose compensation you're voting on. If you're voting on that founder's compensation, yeah, they should certainly be removed from the decision-making process. Now, it's possible that you're voting on compensation of another executive, that even in those cases with the person that you're describing, who's the founder and the executive director and a member of the board, they're probably going to have a conflict of interest and should be removed as well. But this is a case-by-case analysis. You always look at case-by-case. All right, so let me run through, just to summarize what we've talked about. Here's a kind of hypothetical scenario where we're going to go through all these requirements and what it would look like in a theoretical social welfare organization. So first, this organization has decided that the executive committee is going to oversee compensation and evaluation with input and final sign-off from the board. That committee is going to determine who's in the peer group, again, based on revenue, size, i.e. number of employees, their mission and services, and the geography and recruiting area. Then the committee has decided it's going to use nonprofit compensation surveys to determine market range. They have room in the budget to buy one of these surveys and get pretty easy answers to what the market looks like. Make sure you go with a reputable survey. Going on to like salary.com or some of those websites that have some salary information is probably not the best route because the data there isn't objective, it's self-reported. It might not give you a good picture of what the entire market really looks like. So that's why it's a good idea to go with a third-party, specialized service. The committee will then determine within that range where it wants to be in the market. So this committee has decided it wants to be right down the middle and wants to be somewhere in the 45th to 55th percentile of the peer group, and that's going to set a range of salaries, between 125, 140, let's say, and then the committee is going to decide where does our specific individual CEO, based on their experience and their performance, where does their where do those factors place that person on the smaller range that we've narrowed it down to. Okay, and so that's sort of, and then we're going to document this and do everything else we talked about. That's kind of an outline of what this process looks like. So kind of walking away from today, what's the sort of action plan that I would suggest for most folks with respect to executive compensation? For folks who are, especially for folks who are sort of doing this for the first time or who haven't had a good identifiable process in the past, it might make sense to draft a compensation policy that provides this roadmap, provides some clarity and some regularity with how you're going to pursue this process. We don't have a compensation policy template in-house at the DC Bar Pro Bono Center, but I've seen some pretty good ones floating around the internet. Or you can consult with some pro bono counsel, use our services, and we'll help you draft one. Second, review the allocation of responsibility for this decision. So who's responsible? If you have been doing it one way, like let's say you have been doing it with the full board, think about whether it makes sense to spin that off into a specialized committee. You don't have to, but it's a conversation that's worth having. Then review your decision-making process to ensure that you're making use of the rebuttable presumption for IRS purposes. So go through those 4 steps. Is the committee doing it? Are there no conflicts of interest? Are we using the right comparability data for an organization of our size? And then are we documenting the whole process? Ask those questions and make sure that you're doing it right. And even for folks who have done it right, think about whether you want to update your comparability analysis. So for example, if you significantly increase the pay of your CEO, it might be time to do another market survey just to make sure that that new figure is still within range. Also, if you just haven't done your analysis in many, many years, it might be a good time to revisit the analysis and just redo a comp study or a comp analysis. A lot of people are going to ask, well, how many years is appropriate? There's no one size fits all answer here, really. For example, if the last time you did it, you set the compensation at the tippy top of the range at like the 95th percentile, that's a risky place to sit. So I would revisit that figure over time just to make sure that usually salaries are increasing, but like, let's say if theoretically the market's slumped a little bit and then suddenly you find yourself in the 101th percentile, that's not a place you want to be. So if you're in kind of a riskier place with respect to your compensation, probably makes sense to revisit that very often. If you set it right down the middle at 50% and you've provided moderate raises or cost of living increases over time, but you haven't significantly jumped that figure and you're just keeping it really steady, you might not have to revisit it as often, but maybe every 5 years you still want to go back and just make sure you're in a good place in the market. All right. Well, that was my last slide. Good on timing. Let me go through these questions again, and for folks listening live, please do use the questions panel to ask any questions that we have as we're closing out. One question I got near the beginning of the presentation is, can the executive director be paid as a contractor when the nonprofit doesn't have enough money to pay salary? This is a really important question. The answer is essentially no. The question of whether your executives or any of your employees, the question of whether or not they're contractors versus salaried employees is not a decision you get to make. It's not a decision that person gets to make. It is an objective legal test whether or not they're an employee versus an independent contractor. And wherever they fall on the test, that's what they are. And if you call them something else, you're wrong. So the test is essentially truly how independent is that individual. You know, when you hire like a lawyer or an accountant or a plumber or any kind of vendor to come into your organization, they're like independent contractors. You pay them money, they do some work or they perform some services. They do it with their own equipment. You know, they control their schedule. You don't train them, you don't give them an office. They come in, they do their work, they get out. That is the prototypical independent contractor. Executive directors are not independent contractors. They are just too central to the day-to-day function of the organization. They're too accountable to the board. They are, you know, it's going to be basically impossible to correctly classify your executive director as an independent contractor. So just because you don't have enough money to pay salary, you know, that's not a reason. That doesn't magically make that person an independent contractor. If you're strapped on cash, you know, you can keep towards the lower range of how much you're paying, as long as you are paying this person minimum wage, which is the minimum requirement, and maybe cutting hours, so not having it be a full-time position. There are other ways that you can, you know, make it work for your budget, but you can't just, you know, pay them as a contractor and some that you can afford and hope that solves the problem. Okay. Also, you know, we're sort of talking about startup organizations. Can an organization hire a low-level paid employee while the ED is working as a volunteer? That can actually, so if you have a mostly volunteer type organization, my tip for folks is to refrain from calling someone the executive director right off the bat and have that be a so-called volunteer position. So that's a really hard line to police. When is someone working as a volunteer, or when is someone working as an extremely underpaid employee? That's a legal fight that you don't want to get into with employment agencies and with the IRS. So, you know, a lot of startup organizations that don't have staff, the chief kind of operating officer or the chief management officer can be the president of the board or another position that is clearly a volunteer position and a governance position and not a staff position. And then in that kind of situation, yeah, then you can hire some initial sort of maybe part-time staff folks to do discrete tasks, and that's totally fine. Probably wouldn't be this executive compensation conversation we're having today. It would be a lower paid kind of position. What happens if, okay, so this is a good question. What if the board does decide to pay too much? You know, it didn't go through this process or made a mistake. It approved excessive compensation, but the person receiving the compensation ultimately didn't receive it. They abstained or were denied the compensation is what the question says. You know, the IRS kind of excise tax regime that we talked about at the beginning, it's really based on actual amounts paid. That's going to determine what those excise taxes are. So if you actually don't pay the amount, then it's all sort of theoretical. It really only matters when the payments start to happen. As a startup nonprofit, what are some options to attain funding that allows for executive compensation? Well, that's a little bit outside the scope of what we deal with here at the DC Bar Pro Bono Center because we're a legal services nonprofit. We don't give advice on fundraising, but there are lots of great resources in our community and other nonprofits that do provide that kind of counsel or that do provide related services. Okay, we talked a little bit about bonuses. We talked a little bit about CEO tenure. Do you know if federal employees can be paid as nonprofit EDs? There are a lot of rules around parallel or concurrent employment. You know, a lot of private companies have rules around parallel or concurrent employment, and certainly government positions do as well. So I would check with the specifics of the particular office that they're working at, but chances are they are not allowed to have a separate full-time or perhaps even part-time job as a nonprofit ED on the side. But that really depends on the internal rules of that org. For a nonprofit organization, for a nonprofit, is it typical that the CEO receives compensation? And if so, what are the potential sources of funding? I think we've talked about that a little bit. A lot of startups don't have a paid CEO, so don't feel like from this conversation you all of a sudden have to have a CEO. It has to work within your budget, and it has to work within kind of the needs of the organization. Plenty of organizations are volunteer run without a paid executive. As a very small organization, we would be in the lower salary range. How low can the compensation be? So this is what I sort of flagged at the beginning. I'm talking a lot about paying people too much. I'm not talking about paying people too little. When it comes to paying people too little, you have to watch out for minimum wage laws. You have to be paying your person at least the minimum wage. And then the other consideration there is more on that business side of things, right? Like what is competitive, what is going to allow us to recruit talent. If you really can't pay a competitive salary, it might strategically make sense to wait until you fundraised enough to be able to afford that more competitive salary. But that's a kind of business question to have and not so much related to the legal conversation that we're having today. Is the outgoing ED at all conflicted in coming up with salary recommendations or advice for the board for the new ED search? Not if it's in the abstract. So if you have an outgoing ED and they want to provide some insights or some ideas or do a little bit of research with respect to this comparability discussion that we've been having, but they're not going to vote on the new ED's compensation and they're not on the committee, then that's fine. That doesn't produce a conflict of interest. How much of this analysis applies to interim executive directors? It's the same. Interim executive directors are still insiders of the organization. They still exercise substantial influence over the org. So the amount that you pay them should abide by this process. Does the board need to do a comparability study to give a cost of living increase to an ED? If there is a pretty standard COLA, cost of living rate in your job market, and you have sort of documentation for what that rate is, you don't have to, look at the individual cost of living increases that, 10 comparable organizations have done. You can rely on that research generally. That's fine as long as, again, as long as that cost of living increase doesn't kick the amount of total compensation outside of the acceptable range. What about deferred compensation? So compensation that vests after a couple of years as a method of encouraging retention. That's fine to pay folks deferred compensation, but just make sure to count it as compensation. This isn't exactly deferred compensation, but it's reminding me of the Florida example that I mentioned briefly that blew up last year. Part of that scandal was that the executive director was being paid for accrued time off that wasn't being taken, and a lot of accrued time off, like millions of dollars in accrued and not claimed time off over the course of like 3 years. So those sorts of things get counted. I mean, that organization didn't want to count that stuff, but it's counted in total compensation. So any sort of payments, whether they're deferred, whether they're real time, if you pay people severance or an exit payment when someone leaves or retires, the same general rules apply. I mean, that's actually a very complicated conversation and a bunch of other considerations apply, but one of the considerations that applies is whether that amount is in and itself reasonable. And so be really careful if you're going through that process. I would definitely encourage you to seek legal counsel if you're considering severance payments or kind of exit parachute type payments. And finally, someone mentions also consider what is equitable when we're talking about, the low end of paying an executive director. Exactly. There are a ton of not only business but equity related concerns related to sort of what to do when we're operating on the low end, not related to what we talked about today with respect to compliance. Okay, so that was me going through all the questions. It is exactly 1 o'clock, so we are at time. Thank you everyone for coming to today's presentation. Again, my email address is jqu@dcbar.org if there are other questions that occur to you after the fact and you want to ask. And thanks for joining us for Board Basics. We'll be having more of these webinars in the future, and I hope to see you again